Good morning, everyone. It's Phil Wade from Dalton Wade Real Estate Group, and today I'm joined with Ivo,
Hey guys.
Daniel from MI Mortgage,
Hello.
Jim from MI Mortgage,
Morning.
and Lisa, who's holding the camera. And we got the Dunkin' Donuts going on. So everybody who didn't show, hey, you missed out on some good food. So, anyways, Daniel and Jim are from MI Mortgage. And they're going to tell a little bit more about their company and sort of what differentiates them from, kind of others in the marketplace, and, what they see is important, and, what you should be focusing on as an agent. So with that, I'm going to turn it over to Daniel.
Okay, great. Thanks everyone for joining us this morning. Thank you, Phil, for having us. I know that we're talking to everyone that's part of DW, as well as some other agents that maybe are not right now, but hopefully we'll reconsider that going forward. Instead of coming here today and talking to everyone about, this program or that program, or how we're this great mortgage company, and what makes us different, I'm sure all of you get to hear from lenders every day, almost on a daily basis, and I figure that this should be a little bit more educational, and let's talk about things that are tangible, they're important to you guys in this particular marketplace, and what are the challenges that are going on currently. What we see and what we've seen lately is that you have short inventory, and a lot of contracts are just being blown away. Closing dates are not being respected, and I'm going to say something here, and watch out because I'm going to say it. Contractual closing dates are not suggestions. There, I said it. It may seem funny, but it's incredible what's going on. Especially the major banks. With the major banks, I mean, they're late. They're blowing contracts. Closings are not happening on time, and there is a reason for that. And I wanted to share that with you. And there's a little bit of history behind this, but as all of you know, in 2006, 7, and 8, with the big real estate and mortgage crash, a lot of these large lenders and banks were very well staffed. Immediately, almost overnight, all those jobs went away. People either changed careers, or they went into working for servicing, or they went into working for loss mitigation, or foreclosure work. I mean, it just origination basically just halted. It took a good 4 to 5 years for most lenders across the country to see the increasing business that was needed to raise that human capital pool. The problem is, long enough had elapsed where a lot of these people had moved on already to different careers. They had, discovered different professional paths, and were outside of the professional mortgage pool, if you will. Now, all of a sudden, business becomes great again, in 2012, end of 2012 into 2013, and there was just not enough human capital out there. And the ones that there were just not in tune with the changes, because, it's been 4 or 5 years. So you have a lot of these large banks cannot just handle the sheer volume of business that are coming in. And when they do, because of just basic economics, they have to just take care of it very quickly. So at the low end, when I say at the low end, I shouldn't say at the low end, on the retail end, at the street side, you have people issuing pre-approvals, you have loan officers issuing pre-approvals. They are not good. They're just not thorough. They don't spend the amount of time because they get bombarded with 10, 15, 20 pre-approvals every day. Sometimes it's, the pull up one credit bureau, tell me how much you make, and here goes a pre-approval. And you suffer because you get a pre-approval, you go and you show a property, 2, 3, 4, 5, 10, 20 properties to someone. The loan gets submitted, and then 3 weeks into that contractual period, you find out the person does not qualify for one reason. The second issue is, let's say this person is thoroughly pre-qualified. They're not getting these loans done timely. So, inventory short, loans are not closing on time, what happens? Contracts blow up. All of that effort, all of that time goes away. Why and why are people not paying attention to just contractual closing dates? Why, it has to do with service. Just like, if you haven't yet, you will encounter realtors that don't know how to fill a purchase contract. We all come from the same pool, if you will. It's the same regulation. VA has the same guidelines to guarantee loans. FHA has the same guidelines to insure loans. USDA has the same guidelines for everyone. So does Fannie Mae and Freddie Mac. So how can one place take so long to close a loan, or miscalculate a pre-approval up front, and others won't? It comes down to the same thing in any industry, in every industry, and it's service. It's service, and it's also education. It's reliability. We had to work very hard, because we're busy as well, to be able to maintain a level of service that would not create a sense of entitlement within our employees. When business is good, people get entitled. They get 10 loans a day. They say, oh, that's a hard one, I'm not going to work on this one. That's an $80,000 one, I'm not going to work on that one. They fail to realize that the $80,000 loan for that kid that's just moving out of college through a hard condo, somewhere here in South St. Pete, could be a $500,000 loan from a rich uncle that's going to be sitting on the Thanksgiving table, because you get to say, hey, Phil Wade did a hell of a job for my $80,000 condo purchase, and his lender was incredible. That's why every loan must be treated like it's $1 million easy loan. Okay? People forget to realize that when times are good, yes, business is plentiful, but when times are tight, your referring partners are going to stick with you if you truly work hard on every deal, whether it's small, medium, or large. Going back to how the turnaround time should be addressed, and how the strength of the pre-approval should be addressed. And by the way, this is not with us. I'm going to talk about us, but if your lenders are not doing this, go back to them and ask them for this. Pre-approvals are not suggestions of credit worthiness. Pre-approvals should be thoroughly taken via an application. A desktop underwriting should be ran, which is an electronic automated underwriting system available to all mortgage lenders. And after that, an analysis has to be conducted between the loan officer and the referring realtor. Why? Not every deal is the same, just like not every real estate transaction is the same. Phil may call me and say, Daniel, I want you to please work on this client that I just got. It's a great purchase. It's a $200,000 purchase. He's a teacher. He's excited. It's his first house. I may take an application on that person. I may analyze his documents. I may look at the DU findings and see that the back end debt ratio on that person, on an FHA and DU, desktop underwriting, yes. And I may see that that person is at 54% back end debt ratio on FHA, where the limit's 55. Now I should call Phil and say, Phil, he's pre-approved, no problem. Go shopping with him, good luck, we'll wait for the contract. However, pay attention. Stay away from high homeowner associations. Avoid CDDs. Watch out for any flood insurance, even high taxes, because he's very close on his debt ratio. It makes your job a lot easier. The other way is also true. I would also like to call Phil and say, Phil, he's at 30% debt ratio. He can actually go up to 250. Because as we all know, sometimes you look at 10 different houses and you find at 11th that it's just maybe about $20,000 above what your psychological budget was, but you fall in love with it. Well, now that you know that that particular client could potentially go up to $250,000, you can make the call and say, hey, Daniel, would you please run payments? And present that to my client. And then we can present it to the client, and with interest rates as low as they are, sometimes they'll realize that, wow, I can't afford that. That's a small difference for what I'm truly looking for. So that's called an up or down call, and it's something that we do. We issue very strong pre-approvals, and we collect documentation, run DU, and we make the up and down call, so that you are aware when you go out there if this person is tight or if this person has some room to spare on the purchase price. That saves time, and it makes the transaction a lot easier. Once the contract comes back, we're ready to go. If I have DU, if I have the documents, okay, if I already conversed with you about the strength of the deal, once that contract hits our table, we're ready to issue disclosures electronically. They come back, we're ready to put this in underwriting. Our turnaround times in underwriting are 28 to 48 hours, and as they should be in most places. So loan commitment, 72 business hours after the contract arrival, it's not abnormal. What happens is now the ball is in your court. Now you have time to spare. Now you can truly have a 30-day contract and close early. We average 18 days on transactions right now.
Everybody pre-approved with substantive
Absolutely.
documents.
Absolutely. So we average 18 days.
So on that loan commitment that comes out, and some, like, what would be some of, some of the contingencies? Obviously, the appraisal hasn't come back yet.
Mm-hmm.
Have you already gotten the tax transcripts at this point, or not yet? Like, what would still be open?
Absolutely. Initially, and it's funny because this is a great question, Phil, because as salespeople, we all like to do this, and it's something that we shouldn't, but we do. As we're trying to gain the deal, whether it's real estate, mortgages, cars, it doesn't matter. Sometimes we tend to overpromise, and we put ourselves in a position of under-delivery. Sometimes because we just don't have control over different facets of the transaction. And we decided to test something. This is back a couple years ago. We decided to say, okay, if you think that you are going to have a client use you because you're asking for less documentation now and more documentation later, you're out of your mind.
So we just had a question come in on Periscope, so Lisa.
Okay, I'm sorry, go ahead.
What is the difference between pre-qualified and pre-approved?
That's another great question, and that goes with Phil's question, so let me try to answer both together. A pre-qualification, it's almost as good as the paper it's printed on. A pre-qualification is basically what you get on the mail from a credit card company, saying you're pre-qualified. Sometimes that's done involuntarily, meaning mortgage companies will market that you are pre-qualified, call us so that we can take your application. Sometimes you walk into a mortgage company or a bank, and like I said, you give your social security number, date of birth, address, authorization to pull credit, tell them how much you make, and they tell them, based on what you're telling me, you're pre-qualified for $200,000. A certified pre-approval, which is what we issue, and some companies try to use the word pre-approval without doing this, should be based on analyzing credit and analyzing the documentation, and that includes income and assets. Okay. Now there is further documentation to come down the road.
Now, is there any movement out there in the mortgage industry to standard? Because just in terms of what I've seen is that some people call it a pre-approval, some people call it a pre-qualification.
Mm-hmm.
There seems to be confusion in terms of like what actually, you never really know what's been done,
Mm-hmm.
how good it is. Is there any movement out there to sort of standardize, what lenders give and?
Mm-hmm. Unfortunately, there is no regulation on what's a pre-approval and what's a pre-qualification. What's regulated, at least right now, is what's a loan commitment. But we all know that a loan commitment comes after underwriting as the loan's already in process. And that's the problem, because you are faced with pre-qualifications or pre-approvals that you don't know if they're good or not. Now, if you're doing a lot of transactions, you know already that certain institutions are notorious for giving pre-approvals to anybody. There's some larger banks that just like to print them, and we have a lot of referring partners that actually will not take a buyer out with certain pre-approvals from certain institutions. They will say, I'm not comfortable with this. You have to, maybe even if you don't use my lender, please just go through them so that he can verify the accuracy of your pre-approval. This will save you time and us time. And but going back to that question, try to answer that question to at least what matters to you guys is when you get a pre-approval or a pre-qualification, it doesn't matter what it is. It's worth making a phone call to whoever issued that. Whether it's a loan officer at a branch level at a retail bank, whether it's a mortgage lender or mortgage broker. Make a quick phone call and say, hey, did you collect the documentation? Did you collect the asset documentation and the income documentation to back up the fact that they can afford the payment that on the property they propose they could buy, and to also verify that they have the funds for the down payment. Now, sometimes they don't have funds for down payment because they're getting a gift. That's fine. They should be able to tell you that. It's worth the 5 minutes. Because if for some reason that person just tells, oh yes, that's just based on credit and an application online, then it's also worth for you to recommend to your buyer to just go somebody that you know that will give them an accurate certified pre-approval. Very important. This is going to save you a lot of time and your buyer's time as well.
What about on the listing side? If you're the listing agent and then the contract comes in and obviously it's not your buyer, it's somebody else's buyer, but the pre-approval's there, should that person as a listing agent call the lender and sort of check out what that pre-approval is?
That's another terrific question. Yes. And you can go, and it works both ways, okay? What we see a lot of listing agents do is, because inventory is tight, they actually, if they receive offers with pre-approvals, sometimes they will even require the people there, and you can do this in the state of Florida, they're making the offers to get pre-approved by a lender of their choice to make sure that that pre-approval that's coming in is not bogus, okay? The other thing that they can do is they can also make that phone call and find out how strong that pre-approval. We get phone calls all the time from listing agents, asking us about the strength of the pre-approval. And if they're truly doing their job, they can pick up, on the.
What can you tell them? Like just what you did to pre-qualify them? Is that?
Yes, you can't ask obviously personal financial information about the buyer that's making the offer. But what you can ask is, what is your procedure to issue this pre-approval? Do you run desktop underwriting? Do you collect asset documentation and income documentation prior to issuing this? How long is this good for? Is the debt ratio very tight? Have you considered taxes and insurance? Have you considered the fact that this property has flood insurance, for example, when you issue that pre-approval? A good licensed loan originator, which all of them should be able to answer those questions without hesitation. If there is hesitation, or if there is no, I have to look into that, by the way, I'm still waiting for a tax return, then you know that it may not be as strong as you think it is. So yes, absolutely. Do your work up front.
So every pre-approval could be different. So
Absolutely. We see it all the time. A good percentage of our business is actually deals that are already going somewhere that at some point they can't do it for some reason, and they'll call us like, but they had a pre-approval from Wells Fargo, but they had a pre-approval from Bank of America, not mentioning names for any particular reason, just picking them out of the hat. But and then we have to look at them and tell them, hey, I'm sorry. This particular bank, when they issued a pre-approval, you told them you made $50,000 a year, and you're a teacher, right? But you forgot to tell them that you have that side business with Amway, and you wrote off $27,000 in the past 2 years. Certain things you can only see when you look at the tax returns or pay stubs, such as a child support payment or an alimony payment that may be coming out of their pay stub. And people are not in the business of doing mortgages or real estate. They rely on you to tell them those things. So if they tell you I make $50,000, they may not necessarily feel that they have to tell, oh, and by the way, $600 comes out of my paycheck every 2 weeks for alimony. It's not their job. We're the professionals here. So if we're not doing a thorough job up front, you're opening yourselves up for surprises. So do your due diligence. It takes 5-10 minutes to make that phone call. And if you have any questions, call us. I don't care if you're sending us a deal or not, we will assist you.
Awesome. Maybe you can talk a little bit about, this comes up often, is FHA and sort of the overlays that certain lenders put on the transactions, and maybe the person wasn't approved here but could be approved somewhere else. And because I've often been asked, well, if I go on the FHA website, it talks about a credit score of 580. Mm-hmm. This person's way above that, but then they couldn't get approved by TD Bank. So maybe chat a little bit about that.
We got to do this often because his questions are on the money and they're fantastic. And they are actually questions that should be answered more often by this industry. And you guys can use these answers, I'm sure. This is great. FHA, just like VA, USDA, Fannie Mae, or Freddie Mac, they have set guidelines for everybody across the country. The only difference is direct lenders, mortgage brokers, or banks, they can add guidelines called overlays. Overlays are nothing but extra guidelines to protect them. For example, an FHA back-end debt ratio gets picked up, meaning gets approved by DU, given if everything else is in line, all the way up to 55% on the back end. Okay? Well, there are some banks or lenders that say our cutoff is 45. Well, if FHA will insure that loan at 55 and desktop underwriting is saying yes, why are you saying no? Why are you capping this at 45? Well, that's an internal policy decision by the mortgage company or the bank, because they feel that if they purchase loans above that 45% back end debt ratio threshold, they're increasing the risk of default. Because remember, they sell those loans, and if they default, sometimes they have to buy them back. So it's
What would be a case, like what would cause them to have to buy it back? Just the documentation?
sometimes an early default loan. You know, sometimes a loan that was sold and somebody didn't make their first couple payments. It was a very early default. You know, they may force them to buy it back, and things of that nature. So it's called risk.
Mm-hmm.
And you know, mitigating risk is a big part of the banking industry. So what they'll do is they'll add rules of their own called overlays, and those overlays sometimes can make things difficult. So yes, when dealing with a bank or dealing with a lender, ask them, do you have overlays? Basic things such as, what's your maximum FHA back-end debt ratio, VA, you know, Fannie Mae and Freddie Mac? And they should be able to answer that without a problem. You know, just take notes. And if you want to know what those are, hopefully, Phil, we'll have some more of these training sessions where we can share some of those details. But we'll also, you know, actually, I'm going to make that available to you. We'll create some kind of a cheat sheet that has the raw guidelines, if you will, that you should be able to know. So that if you are asking questions and if there are overlays, you can identify them so that you're not sending all of your business to a lender that has overlays or excessive overlays, because it can cost deals. You know, you don't want.
Where are you guys on FHA?
55.
And then what about like the credit score?
All the way down to 580. That's another interesting thing. It was part of your question. I'm sorry I did not answer that. Yes, you can go down to 580 on FHA. The difference is middle credit scores between 580 and 620 do not fall into the category in which you could run and get an approval through desktop underwriting, which is DU. If it is under that 620, it has to go through a process of manual underwriting. Now, when it goes through the process of manual underwriting, then there is a cap on that debt to income ratio, which the back end, if I'm not mistaken, is 43%.
Okay, so they have a lower credit score. They need a lower debt to income to be able to.
Correct. It's a black and white underwrite. It's a manual underwrite, so they don't have that automated approval saying, okay, great, you can go up to 54 or 55. No, it's going to cut out in 43. They're going to verify your rent history. You know, it's a little more thorough because there's enhanced risk. But yes, between 580 and 620, you can do an FHA loan.
So it's still possible to get somebody done at that level?
Absolutely. Anything between 580 and 620, 3.5% down, FHA. You know, it could even be a gift. It just has to be manually underwritten instead of DU. By the way, we still honor our 30-day turnaround time, contractual closing dates on manual underwrites. And I didn't mention this before.
Even for FHA and VA?
Even for FHA and VA. You know, we put our money where our mouth is. We have a $1,000 close on time guarantee on 30-day contracts, and we have not paid it once this year. Okay, not once. Obviously, you don't want the clients to procrastinate on giving you documents to get that $1,000 close on time guarantee. That is done obviously lawfully in the form of a lender credit towards closing costs at the time of the closing, if the case arises. But we never had to worry about that because clients are motivated and excited to get into their homes. They will work with you. They'll give you documentation. If you're thorough up front and you collect all of those documents and you're ready to go and that contract hits your desk, there is no reason you should not meet a contractual closing date. Like I said, they're not suggestions. You cannot play with that. These are people's lives. They make plans. How often you have clients that they need one more pay stub for some reason, or something came up a few days before the closing, and you call the lender says, oops, underwriting 72 hours, and that's going to trigger another closing disclosure, so that's 6 days out now. Please get a contract extension. Now you have a client moving down from Rhode Island with a U-Haul full of stuff, 3 cats and 2 dogs, and you got to explain to them why they can't move in. Okay? That should not be happening, and it doesn't have to happen if people would do their jobs up front.
Great. So, in summary on that one, if you maybe have a borrower with a slightly lower credit score, Danielle would seem to be able to, help them where maybe, a TD Bank or Bank of America, they're not going to get pre-approved. So just that's a quick one on that. Maybe talk a little bit about, condos are sometimes difficult. You've
Yes.
got warrantable and non-warrantable condos.
Absolutely. Let's talk about that. That's a big one in this area. And in Florida. Florida, we're the land of condos. You have to understand that condos present an enhanced risk for investors and for mortgage companies. And the reason why, especially in an area like this, it's because they have to rely upon every single unit making larger contributions to. So there's a potential of larger depreciation. Typically when there's a wave of foreclosures, condo tend to get foreclosed a little bit faster. So there's enhanced risk in condominiums. So it's different for Fannie, Freddie, and for FHA. Keep this in mind. As a rule of thumb, the condominium must be approved by FHA. There are very few, even in the state of Florida, there are.
So that's the condominium association, not just the borrower.
Correct. Not the borrower. This is different.
Yep.
The project itself, the condominium itself, must be approved by FHA in order to obtain FHA financing. Very rare in the state of Florida. Very few. To the point where sometimes if you call, they don't even accept an FHA offer.
What about VA? Is that also
Same
thing, right?
Now, conventional is where mainly most of the condo financing comes from. Now, there's always that question. Well, I hear that you can put 5% down on a conventional loan on a condo, but others will require 25% down. Which is your question. That depends on how healthy that association and project is in the eyes of Fannie Mae and Freddie Mac. What happens is a condominium questionnaire sent to that association by the lender.
So that's a full review, correct?
Correct. And there are certain questions there, such as, what do you have in reserves? Do those reserves meet the basic requirement reserves to operate the condominium?
Is that still 10% of the income has
Correct.
to go to
That's still
reserves?
10%. Yes. Do you have an excessive amount of units in default of the association?
Is that 15%?
Correct. Do you have the most of the units are owned by the same person, over 50%? One person owns half of the development. That obviously it's enhanced risk.
But 10% throws it off, right?
Correct. So there are and there's different things that I can't speak of because that's more of an underwriting job. But those answers will trigger if this fits within the warrantable condo or not. If it fits within, it's a 5% down payment requirement. If it does not, it's a 25% down payment requirement. Now,
do you have any special programs where, like, somebody might do 15% down, they had a 700, credit score?
no, we do not. We
Okay.
follow Fannie and Freddie,
Okay.
so it's 5 or 25.
Yeah.
Now, here's
I have questions.
yes.
If a buyer pay this 25%, it doesn't matter the condominium association it's approved, they can get the loan, or there's
Correct.
still restrictions.
There are no restrictions. It's either 5 or 25.
Okay.
Okay, it's either 5 or 25.
So there's
Okay,
that's-
quick
Unless
question.
there is a major problem within that property that comes up, such as there's a major structural problem, or on title, there's some big open liens on the property, that there's a large assessment coming up that the lender doesn't want to risk lending against. So there could be, but not very. It's not very common that would happen.
Okay, so this person wanted to know if there was a website for FHA approved condos and VA approved condos, and yes, there are.
Yes, there are. Easiest thing to do is literally go to good old faithful Google and just type FHA approved condo projects in a certain state or city in a county, and it will come up. Now, here's something, and it's funny because there's one here in downtown St. Petersburg, close to us, which is that building on 5th, right by the Mahaffey, and it's one of the very few
That's approved.
that's approved. Yes, FHA approved. But okay, so
But for
how?
conventional, there's no approval.
No, it's either
Right.
5 or 25, and
Right.
that's just based on the answers to the
Now, the
question.
5% is if it's gonna be their primary residence, or, but it can't be an investment property, correct?
No, not an investment property. There's some
What if it's a
loan
second
to
home?
value. Same thing on second home, the 5. But if there is an investment property, then there's some LTV adjustments I would have to get them to you on the condo. But let's talk
So
about
that's a bigger down payment.
correct bigger down payment. Let's talk about what you guys should worry about when let's say showing a condo to prospective buyer. You should be able to rely on the listing agent to have done his or her homework and say, by the way, this condo is going to require 25% down or 5. Okay, they should be able to do that homework. After all, they're listing this property, right? That's a big deal. Unfortunately,
Right now it's not the right time.
you can't rely on the listing agents, sometimes in obtaining that answer. So the best thing would be to call the lender that has pre-qualified your buyer, and ask the lender that has pre-qualified your buyer to do some homework on it. And
So
the
that's
right.
not up to the eight, because usually what we try to do is call the management company and then
Mhm.
ask if, those things that are gonna trip it up, and make it, I mean, I have the 4, you know, the reserves being 10% or more, nobody owning 10% or more of the units, 15% or more of the condos delinquent, and then litigation.
Correct. And that's perfect. You know, if you would like to go ahead and do that yourself, absolutely. If you'd like assistance, we would happily call for you and try to do some of that digging. Now, that would be a verbal verification of the condominium's fitness. So, you know, all we would be doing is doing some fact finding for you. That questionnaire, it's really
Now, on a
what it's
limited
going
review,
to.
does the question of litigation come out?
On a limit, I have to get that answer for
Yeah.
you. I'm not 100% sure if on the limited review that question comes up or not. It may, because I think litigation.
Now, does
it-
desktop underwriters spit out whether it's a limited or full review? Is that how that works?
No, because desktop underwriter reacts to what you're
Putting in?
putting in. Correct. So, you know, if you're saying it's 25% down, it's limited, then it's going to react to that. Just like it can give you an approval with 5% down until you get the condominium questionnaire and underwriter reviews and says, oops, it's not 5% down, it's 25. So you could have even have a desktop underwriter, which would, you know, later not become valid because the condominium association questionnaire came not looking so good. So to protect your buyer, when looking at a condominium, ask the listing agent if you're not really happy with the answer, if you don't think the answer is very educated, check with your lender. Your lender should do this kind of work for you. If they don't, give us a call, we will.
One last question on that, conventional for condos, is the owner occupancy, so that no longer is an issue?
Well, I
Because there
believe,
was, you used to have the 50% or more.
correct. I believe that there are still some guidelines to the amount of owners versus renters. But like I said, it has somewhat, condominium financing it's something that's been changing so much,
Right,
it has
right,
changed
yeah.
so much. So that's something that, again, we would probably have to take a better look at to make sure that we can give an accurate answer. But all of those things that enhance risk or decrease risk have some kind of an underwriting effect. And having a better understanding of it is always the way to go. But it's, you know, if you're a realtor, yes, having more and more knowledge, which is something that you promote all the time and it's terrific, helps tremendously. But, you know, if you think it's a little overwhelming or you're not really understanding, like I said, don't hesitate, make a phone call. Put this on somebody else's shoulders.
Call
You
the
should be
lender.
able call the lender. You should be able to get an accurate answer. It's their job.
Great, that was a great synopsis on FHA and conventional. Anybody in Periscope land with any additional questions?
And I have questions regarding the investment of the condominium. What is the guidelines specifically for investor standpoint who buy and purchase a loan with conventional?
Well, if an investor is purchasing a condominium as an investment property, then obviously he has to adhere to investment property purchase guidelines. There is a maximum amount of properties you can own as a, you know, with
That's
conventional
5.
financing. I believe it's 5.
Yeah.
But then yet the other day somebody suggested it could go up to 10. Again, we have to look into that because most investors that have been purchasing cash or with the help of a hard money lender, you know, for the past 5 or 6 years because they've been turning those very quickly, and you know, so. But yes, there's going to be a much larger down payment. There is also an interest rate enhancement because interest rates go with risk, and obviously you always let your first property go. I'm sorry, your investment property go before the house where you live. So that's enhanced risk. So the interest
Higher
rates will be
rate,
a
yeah.
little bit higher, correct?
Thank you. Lisa, any questions? Anybody in Periscope land? All right, thank you so much. Great session.
You're very welcome. Thank you for the opportunity. We hope to come back again. I'm sorry, I think there's a question coming in.
Yeah, do townhouses have the same issues or concerns as condos?
No, this is what a great question. All right, this is Phil. I'm sorry, this is the
Yeah.
question of the day
Oh, good.
because this will really help you guys. A townhome, okay, unless it's booked in a different fashion. Most of the time,
Now, a
they're
townhome
fee
has
simple.
a different legal structure than a condo.
Correct.
Yeah.
Most townhomes, okay, some not, but I mean the vast majority of them are fee simple. They may have an association, but they're treated by FHA and VA as a single family residence, if you will. So this in a villa, by the way, in a villa. So this is a great, the reason why this is a great question is because sometimes you may have a buyer that says, I want to purchase a condo or a townhome or something of that nature because I don't want to have to deal with a big yard. You know, I want to have close neighbors in an association. But I only have 3.5% to put down, or 5% to put down, or I have VA benefits. Well, that's fine. We're not going to go into look into condos like stacked condos. Let's look at townhomes. Let's look at villas. You still have the homeowners association to take care of the exterior. You still have everything you're looking for within accessible financing. So yes, townhomes, villas, treat them like they're single-family homes because in the financing world, we view them the same way. This should make your life a lot easier when you have buyers looking for condominiums. Great question.
Any others out there? Thank you so much. That was really informative.
You're very welcome. We will, again, I'm Daniel Maciel and Jim Ronacher with MI Mutual Mortgage. Phil is going to, I believe, broadcast our information. We would love to earn the opportunity to do some business with you. Even if we don't, we're available as a resource. You can call us anytime. As far as availability, we work on a call schedule, much like doctors. We're all human. If you have a lender that tells you, I always call back, I always return calls, don't trust him because he doesn't use the restroom, okay? So, and if he doesn't use the restroom, he's not human. We're humans, so we work on a call schedule so that evenings, weekends, whenever, somebody's always 15 minutes away from our system in case we need to answer questions, issue a pre-approval, and assist you. 30-day close on time guarantee, or we credit $1,000 at closing. We haven't had to pay this once this year. You know, reliable upfront pre-approvals. If you'd like to do business with people like that, give us a call. If not, demand that from who you're doing business with, and use us as a resource regardless. Thank you very much. Have a wonderful Saturday and a terrific upcoming week.
Even with VA, a 30-day close?
Absolutely. No difference. VA, FHA, no difference. The only one that can get a little bit longer is USDA because we depend on USDA to do their part of the work. And then I can guarantee a lot, but I cannot guarantee governmental turnaround time.
Can you sign off with your phone number? Somebody's asking.
Absolutely. I'm going to give you my personal cell phone number. It's area code 813-758-0006. Once again, it's 813-758-0006. If you want to shoot me a text or give me a call at any time, save my number. Just put Daniel, mortgage guy there so you can pull me up anytime. We'd love to hear from you and hopefully help you.
Thank you.
Thank you.
Thank you.